Alhambra CEO Joe Calhoun discusses valuation. Is the stock market overvalued or undervalued?
I get asked a lot about that, about, was the market overvalued or undervalued? How should we think about it? And I think that I think it's important, but I think it's also something that's very, very controversial. So we're gonna go through today some things. We'll talk about the Shiller PE a little bit, which is popular with people who want to say that the market is overvalued for whatever reason. And we'll talk about what we do. And I think what we do is quite a bit simpler. This chart is popular among advisors, especially those who, for whatever reason, like I said, I want to say that the market is expensive. It's a kind of a stylized version of the Shiller PE. It also includes the Q ratio, which is the value of the market relative to the size of the economy, something that Warren Buffett has talked about. But I think there's a couple of things to realize here. The Shiller PE, which is really what this mostly is an average of the 10 previous years of real earnings. It's Robert Shiller came up with this, and look, Robert Shiller is a lot smarter than I am. He's got a Nobel Prize. Good for him. But he is an academic, and he's trying to make an academic point here, and this makes it quite well. The academic point is that if you start with a high valuation, you're going to get lower future returns than if you started with a lower valuation. Well, kind of makes sense if you think about it. And it doesn't really mean all that much. I can tell you for sure, though, one thing he didn't intend for this to be was a timing tool for investors, because it doesn't work very well for that. 10-year periods, there's a lot of rolling 10-year periods here from 1871, which is usually where his data starts. If you start from that time and you roll 10-year periods, that's a lot of 10-year periods. And you can go, there are plenty of 10-year periods where the real return over that decade is fine. Even if you started with a high Shiller PE, it was still okay. The average it shows that higher valuations do tend to produce lower returns. I think it also matters too that we've just come through a period of very, very slow growth. The last period after 2008, after the crisis in 2008, that period up until 2020, until COVID, was the slowest period of nominal growth since World War II, really. And so it was a very slow time for the economy, a very poor economy. Earnings only grew at 6.3% versus 9.4% historically. So you had a very, very low earnings growth. And the price, obviously, because interest rates were essentially zero, the price could go to the moon, and it did. And so we did have a high Shiller PE, but a lot of that was because earnings weren't good. So I want to show you what we do. We don't look at this that much. I mean, we look at it because it kind of gives us an idea, but we don't put a lot of faith in it. It certainly doesn't have anything to do with what we're doing with the market today. It's not a timing tool at all. So what we do is, a lot of people know about the Fed model. The Fed model is you compare the earnings yield of the S&P 500, and earnings yield is not complicated. It's just the inverse of the PE. Price to earnings ratio, you flip it upside down, it's an earnings to price ratio. It gives you a yield rather than a PE. So what we do is we compare to the triple B. A lot of people want to use the Fed model, which is to compare to the 10-year Treasury note, but I'm going to show you why that really doesn't make sense. We use the triple B because that's the average credit rating for the S&P 500. Right now, that yield is 6.4%. Here's why we don't use the 10-year Treasury note. The 10-year Treasury note has no credit risk to it at all. And what happens during recession? What this is called a credit spread. This is the yield of that triple B bond relative to the 10-year Treasury note. And you can see during recessions, 2003, 2008, 2020, that this spread gets wider. And what that means is that the triple B yield is rising because we're in a recession. People are afraid about default. And so this triple B rate rises. The 10-year Treasury note actually usually falls. The yield falls during recession because people are rushing to safety. So the spread widens out. And what that does is it reduces the fair value of stocks because this triple B yield has gone up. Now, think about it. What it would say if you were comparing to the 10-year would be during recession that the fair value for the stock market actually goes up. And that just doesn't make any sense. It doesn't pass the smell test. So we don't use the 10-year Treasury rate. It's important to us for other reasons, for helping us decipher the economy, but it doesn't help us with valuations. And by the way, you can see too that we're a little bit below average here. 1.57 is the spread right now. The average over the long term back to 1997 is about 1.97. So there's not any credit stress right now. So this is that earnings yield for the S&P 500 that's over here. That's the inverse of the PE. The PE right now is 17.8. If you flip that around, you get 5.7% as an earnings yield. And that is less than the 6.4% you get in the triple B. And so it seems like the market is, in a snapshot, is overvalued somewhat. But you can see this is just the yellow line here is the actual PE. The blue line is what we call fair value. That's that triple B yield. And you can see that there's a slight gap here. We can also see there's been bigger gaps in the past. So, you know, it doesn't mean all that much. It's a little bit overvalued. But it's also, you know, doesn't mean necessarily that you don't buy stocks, or you don't buy the S&P 500 in this case. Why? Well, because earnings are growing. Whereas you buy that triple B bond today, you're going to get 6.4% for 5 years, and that's all you're going to get. If you buy the S&P 500, you're going to get the earnings yield, and you know you don't really get the earnings yield. They don't pay out all the earnings, but point is that the earnings yield is going to go up, assuming that interest rates go, or excuse me, assuming that earnings go up. Then that earnings yield is going to rise over time if the index is unchanged. So what we can see that either in a rising earnings yield, or you can see it in a lower price earnings ratio. But what this is, I want to go over this a little bit. This is the quarterly earnings trend for the S&P 500. This is a really important point, I think. You hear all the time now people talk about that the earnings for the S&P 500 are down year over year, and that is true if you're talking about trailing 4 quarters of earnings. So if you take Q3 2023 and you take the previous 4 quarters and add them together, and you compare that to the previous to 2022 third quarter and the previous 3 quarters from that, then you do see that today's earnings are a little bit less than they were a year ago. But in that case, you're looking at earnings in the extreme case of from 2021 and comparing them to today. I don't think that makes any sense. So what we look at is, what are the earnings in this quarter versus the same quarter last year? That makes more sense to us. And so what we see when we do that is that earnings actually bottomed last June, and the second quarter of last year was the low point for earnings. And if you think about it, the stock market ended up bottoming in July. You rallied up big in August. You did have another sell-off. You sold off again into October. But really that July to October period, that was the low in the stock market. It was also the low in earnings. And if you think that earnings and stock prices aren't correlated, well, I've got news for you. They are. And this proves it. Earnings are up. If you look quarter to quarter, third quarter to third quarter, 2023 versus 2022, earnings are up 17%. And if you get to fourth quarter, which we're coming into now, if we hit the estimates on the fourth quarter, it's going to be about a 13.5% change from fourth quarter 2022. So it is definitely rising, and that's why the stock market's been going up. So if we look, though, earnings growth historically has averaged 9.4%. If we take that historical growth rate and we apply it to today's earnings estimates for 2024, we take it out. If the price of the index doesn't change, we're talking about 12 times 2028 earnings. So look, rising earnings make a difference because it's compared to a static interest rate with a triple B bond. So if we look at earnings yield instead of PE, based on that historical earnings growth, you're talking about roughly a 7% average earnings yield over the next 5 years for the S&P 500 versus that 6.4 for the triple B bond. And if we get the expected earnings growth, which is higher, the earnings of the S&P 500 are expected to grow about 12%. If you get that, you're going to have almost, actually, it's about 7.5 is the median in these numbers here. So you've got a much higher earnings yield than you do with the triple B bond. And by the way, this expectation is what it is, but I would just point out that companies tend to beat expectations every quarter. So the expectations are probably too low. By the way, just come back to this for a second. Expected earnings growth. Expected earnings growth is going to be a function, too, of nominal GDP growth. We just came out of the worst decade ever, worst decade since World War II for nominal GDP growth. I think it is not unreasonable at all to expect that nominal growth is going to be higher in the next 10 years than it was in the last 10. So the last thing I want to look at is look, you don't have to buy the S&P 500. You know, we still think it's expensive too. Look, you've got a price to earnings ratio almost 18 and earnings growth of a little over 12. To us, that's not a great risk reward, risk reward ratio. But there are other areas where you can invest. And by the way, we don't own the S&P 500. We haven't owned this in our portfolio since late 2020. We sold it because we thought it was too expensive. There's other problems with it too. It's too concentrated, but the bottom line is it's too expensive. So there are other areas where you can invest that are not as pricey though. High dividend stocks, which we own, you still have a little bit higher PE than the growth rate because these are a lot closer. And when you get into mid and small cap, most of the mid and small cap space has a growth rate, an expected earnings growth rate higher than the current PE. That is a bargain. And especially when you look at small cap dividend over here, you got an earnings expectation of almost 16%, growth rate of 16% versus about a 10 PE. And by the way, we own high dividend, we own mid cap, we own small cap value, we own small cap dividend. We also own EFA value, which is international value, non-US value. Again, you can see a price to earnings ratio it's very close to what the earnings growth rate is expected to be. And there are other places you can invest too. The Eurozone expectations for growth are higher than the PE. Emerging markets, we're not crazy about emerging markets, but it's not really about valuation. It's about the fact that like 40% of the index is in China. We don't really like that. But if you want something in emerging markets, go to Latin America. Here you get a lot of bang for your buck. You get a lot of earnings growth for a low PE. And Japan is on here as well. We do own Japan. We owned it for a very long time. It's not really an earnings story. You need to know why you're buying something. We own Japan because of the balance sheet story, and that's another entire topic which we won't cover today. So the point is that you don't have to buy the thing that's overvalued. Even if the S&P is overvalued, you don't have to buy it. There are plenty of other things out there you can buy that are very reasonably priced, and that's what we're doing. So anyway, that's what we do with valuation. To us, it's a moving target all the time because earnings are always changing. The price of the index is always changing. Interest rates are always changing. It's always a moving target. And you always want to evaluate where you are and where you are in the business cycle. There's a lot of things to consider when you're talking about is the market overvalued or undervalued. We see right now that most of the market is at least fairly valued, if not undervalued, whereas the S&P 500 is kind of the outlier. That's the one that we are not really interested in because we just don't think it offers a very good deal. So I hope that helps, and we'll be back next week with another topic. I don't know what it's going to be yet. I have to figure that out, but I hope this was helpful.
If you like these videos, give us a thumbs up, subscribe to the channel, and turn on notifications so you'll know when we post new information. You can also subscribe to our free newsletter at alhambrapartners.com/commentary analysis.